This morning, the United States government said that about 9 million barrels of oil a day are leaving the Strait of Hormuz. That same week, satellite and transponder tracking counted 84 ships crossing it. Not 84 a day, 84 in total for the entire week. And JPMorgan, sitting somewhere in the middle, thinks the real number is closer to 4 million barrels. Now, those three figures cannot all be describing the same waterway. One of them is wrong, and possibly two, which would be a fascinating argument for shipping analysts to have quietly among themselves, except for one thing. The inflation number that came out this morning, the one that just moved the entire American bond market, depends on which of them is right. Let's start with the good news because it was real. July's Consumer Price Index landed this morning and it was clean. Headline inflation rose 0.1% on the month, 3.4% over the year, down from 3.5%. Core inflation, which strips out food and energy, rose 0.2% on the month and 2.5% over the year, down from 2.6%. Both of those came in right where economists expected. No nasty surprise. Stocks rose, the 2-year Treasury yield fell to 4.19%, the 10-year fell to 4.66%, and a chunk of September rate hike risk got priced straight back out. That is a market exhaling. And if you stopped reading there, you would conclude the inflation problem is slowly, boringly resolving itself. Look at what actually delivered that number. Energy prices fell 1.5% on the month, and that single component did most of the heavy lifting. Shelter, by contrast, rose only 0.1% and still accounted for roughly 2/3 of the entire monthly increase. Read that again, because it is the whole game. The non-energy part of this economy is not getting cheaper. It is being masked. Energy is the reason today's headline looked calm. So the quality of that inflation print is entirely a function of the price of oil. And the price of oil, right now, is a function of one waterway. Let me back all the way up, because if you have not been following this, none of it will land. The Strait of Hormuz is a channel of water between Iran and Oman. At its narrowest, the shipping lanes running through it are a couple of miles wide. That is it. That is the whole thing. It is not a canal somebody built, and there is no alternate route around it out of the Persian Gulf. And through that gap moves a very large share of the world's seaborne crude oil, because Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Iran all load their tankers inside the Gulf, and every one of those tankers has to come out through the same doorway. So when people call it a choke point, they mean it almost literally. It is a place where the entire global energy market has to squeeze through a gap you could see across on a clear day. Which means whoever controls that gap controls a number that eventually shows up in an American supermarket. Since the end of February, that doorway has not been working normally. Traffic through the strait has been disrupted for close to 6 months now, following the outbreak of open conflict in the region. Ships are not simply sailing through the way they used to. What movement there is happens largely in convoys, under naval escort, which is a fundamentally different thing from ordinary commercial shipping. To give you the scale of that change, Lloyd's List Intelligence puts the pre-crisis baseline at roughly 73 vessels transiting per day. 73 every day as the normal background hum of the global oil trade. On the 8th of August, the count was 8 ships. 8. So when the official position is that flows have recovered, the question that matters is not whether some oil is getting out. Obviously, some oil is getting out. The question is how much and whether anybody can actually prove it. So here are the numbers on the table. The U.S. Energy Secretary said this week that the 7-day average for oil leaving the strait is up to almost 9 million barrels a day, and that combined with pipelines and export terminals that bypass the strait entirely, total regional flows are running around 15 million barrels a day. He went further and said that on one Sunday, more than 20 million barrels left the region, which would be above the pre-conflict average. Against that, Kepler, which tracks oil using satellite imagery and shipping transponders, counted 84 vessel transits through the strait in a week. Set that beside a normal baseline of about 73 per day, which works out to something north of 500 in a week. And JPMorgan's read is that oil is indeed getting out, but the number is closer to 4 million barrels a day. Less than half the official figure. Now, I want to be careful here, because this is not a story about anybody lying. These groups are measuring different things in different ways and reporting them with equal confidence. But an economy cannot run on 3 incompatible numbers. How do you settle an argument where everyone has a number and nobody agrees? You stop counting ships and you go look in the tanks, because inventories cannot be spun. Either the barrels are in storage or they are not. And here is what storage says. Global oil inventories are drawing down at a record pace. The Energy Information Administration puts the global draw in the second quarter of 2026 at 8.5 million barrels a day. That is the largest quarterly inventory draw ever recorded. And the projection is that inventories in the developed economies keep falling until the final quarter of this year, dropping below 2.3 billion barrels by December, which would be the lowest level in agency records going back to 2003. Now hold that against the claim that flows are back to normal or better. If oil were genuinely arriving at pre-conflict rates, the world would not be emptying its storage tanks at the fastest rate anybody has ever measured. You do not drain the reservoir while the river is running full. All right, let me argue against myself for a minute, because the opposite case is not stupid. First, vessel counts are a genuinely imperfect measure. Ships can and do switch off their transponders, particularly in a conflict zone, and a satellite count will systematically undercount traffic that does not want to be seen. Second, ship count is not the same as barrel count. A smaller number of very large tankers, loaded fuller than usual, moves considerably more oil than the vessel count alone would suggest. Third, and most importantly, the Energy Secretary explicitly included pipelines and export terminals that bypass the strait completely. Those routes are real, they have been expanded, and oil moving through them never appears in any Hormuz transit count at all. So it is entirely possible for regional exports to be healthier than the strait itself looks. All of that is fair, but none of it explains the inventory draw. Bypass capacity and full tankers still have to show up as barrels somewhere in the world's storage, and storage is going down at a record rate. Which brings me to the tell, and it is my favorite detail of the entire day. Gold went up. Gold closed around $4,415 an ounce, up about 1.1% after touching $4,434 on Tuesday, its highest level since the 5th of June. Now think about what should have happened. Inflation came in cooler than the month before. Bond yields fell. Rate hike risk got priced out. On a normal day, that combination is mildly unhelpful for gold. Instead, gold rallied to a 2-month high. That is not an inflation bid, because inflation just came down. That is a geopolitical tail bid. That is the market paying up for insurance against exactly the scenario we have been describing, plus steady official demand underneath it, with China's central bank adding roughly 20 tons in July, its 21st consecutive month of buying. So here is where this lands. Day's inflation print was good, and it was good because of energy, and energy is resting on a number that 3 credible institutions measure 3 different ways. The Federal Reserve is going to set policy in September using it. Forbes ran a piece this morning noting that a lack of reliable data now plagues crude oil market assessments generally. That is the real story of today, not a number, the absence of one. So here is the question I would sit with. If the most important input to American inflation right now is a figure that 3 serious institutions measure 3 different ways, then what exactly is the Federal Reserve using when it meets in September? Tell me which number you would trust in the comments. And watch the inventory reports because storage does not hold press conferences. This is research and education only, it is not financial advice. I'm Frankie. The asymmetric signal, one contra Ryan read a day. Subscribe.